You've probably noticed it, right? At the gas station, in the grocery store, even when you're just paying your monthly bills. It feels like everything, all of a sudden, costs way more. So what on earth is going on? Let's get into it.
It's the big question on everyone's mind. Why doesn't our money seem to go as far as it used to? From your morning coffee to the phone you're probably holding right now, prices are just climbing and climbing.
The thing is, it's not just one thing. There's no single villain to point to. What we're seeing is more like a perfect storm. 4 huge forces all hitting the global economy at once. So let's investigate them, one by one.
All right, first up, let's talk about the big one, oil. The price of oil is like the foundation for our entire global economy. And when it shakes, it has this massive ripple effect on pretty much everything we buy.
You know, we usually just think about oil when we're filling up the car, but it is so much bigger than that. It's the energy that powers our factories. It generates a ton of our electricity. It's even in the plastics that make up so many of our products. So, when oil gets expensive, the cost of making stuff and the cost of moving stuff, well, it has no choice but to go up too.
And you can see this domino effect play out so clearly. It all starts with the price of oil shooting up. That immediately makes transportation more expensive. We're talking ships, planes, trucks, you name it. And since just about everything you own had to be shipped from somewhere, that extra cost has to be paid by someone. And guess who that is? Yep, it gets passed right on to us. It's a simple but incredibly powerful chain reaction.
Okay, so that's the cost of moving goods. But our second factor is about whether those goods can even be moved at all. Let's talk about the global supply chain.
You see, in a perfect world, products flow like water from the factory right to your front door. But lately, things like global conflicts and political tensions have thrown a massive wrench into the whole system. They create these huge bottlenecks and delays that you can feel all across the planet.
And this is really the difference. On the left, you have a healthy system where things just work. But when that system breaks down, like you see on the right, stuff gets stuck. Goods can't get where they need to go, and the result? Shortages.
And we all know what happens when there's a shortage, right? It's classic supply and demand. When a lot of people want something, and there's suddenly not a lot of it to go around, prices don't just creep up, they skyrocket. Think about it. A shortage of one tiny computer chip can bring a whole car factory to a halt, which makes the few cars they can build that much more valuable.
All right, let's move on to our third major factor. This one is all about the power of money itself, specifically the US dollar.
So what does a strong dollar actually mean? Well, if you live outside the United States, it means your local money buys fewer US dollars than it did before. Now, why does that matter? Because a ton of the world's most important goods, like oil and grain, are traded in US dollars. So when the dollar gets stronger, it's like an automatic price hike on those essentials for the rest of the world.
Just think about all the stuff a country might import, things like mobile phones, fuel, even basic food items. If your country's currency is now weaker against the dollar, it simply costs more for local businesses to buy those same exact items. And that extra cost? It gets baked right into the prices you pay every day.
And that brings us to our fourth and final factor. This one's a bit different because it shifts our focus from these huge global forces to decisions being made inside company boardrooms.
You might have heard this controversial term floating around, greedflation. The basic idea is this. When everyone, customers, the media, everyone is already talking about rising prices and expecting them, some companies might see an opportunity. They might use that expectation as cover to raise their own prices a little higher than they need to just to boost their profits.
The argument goes that some companies secretly increase their prices even more to increase their profit margin. Basically, the general chaos of inflation creates a smokescreen. It allows for price hikes that go beyond just covering new costs and instead go towards padding the company's bottom line, all while the rest of us are feeling the pinch. So, we've looked at 4 pretty distinct factors. But the real kicker is how they all connect and feed off each other to create one massive self-reinforcing problem.
So let's just recap. You've got the initial shock of super high oil prices. You've got the chaos of broken supply chains causing shortages. Then there's the financial pressure from a strong US dollar making imports more expensive. And finally, you have companies, maybe, just maybe, using all this as an excuse to raise prices even more.
And this is the key takeaway, right? None of these things are happening in a bubble. Higher oil costs make it even harder for those struggling supply chains. A stronger dollar makes that already expensive imported oil even pricier for most countries.
It all creates an environment where raising prices becomes normal, expected even. It is a truly vicious cycle.
So after all that, we're left with one final critical question. When you're looking at a chain reaction this powerful, with so many parts all locked together, is there a weakest link? Is there a single part of this chain that, if you could break it, would make the whole thing fall apart? And if there is, where would you even start?